Geopolitics. This isn't just another buzzword. For investors, it's becoming a critical part of the conversation. Geopolitics is the study of the significant factors shaping international relations, such as military strategy, economics, and geography. This constantly evolving landscape begs the question, does geopolitics really matter for investors? And if so, what strategies can they employ to manage its risks, but also to capitalize on its opportunities? Simply put, yes, geopolitics does matter. And yes, there are things we can do about it. But to understand the reason why, there's some nuance we've got to unpack. For starters, conventional wisdom suggests that over the long term, geopolitics has a minimal impact on markets. The evidence typically given for this is the resilience of the S&P 500. Historically, US markets have tended to recover or advance within 12 months of significant geopolitical events. However, just looking at the US market downturns to gauge the impact of geopolitics doesn't give us the whole picture. Over the last century, many geopolitical advantages have supported the US market, from victories in major wars to its status as the global superpower and reserve currency. It's the positive impacts of geopolitics that can often go unseen in the charts. In any case, when we start to shift our focus away from the broad US market towards specific sectors and indeed other countries, a different perspective emerges. From the travel sector during COVID to wheat prices after Russia invaded Ukraine, the impact of geopolitics on markets is unfolding in real time. Globalization and the rise of China may be one of the best case studies for the impact of geopolitics on financial markets. China's ascent has reshaped global dynamics, from supply chains to trade, so much so that it's now perceived as a geopolitical threat. Today, China makes up around 35% of global gross manufacturing production. That's more than the 9 next largest manufacturers combined. And that's up from around 5% in 1995. This shift proved fatal for some Western manufacturing companies, yet it was a windfall for raw material suppliers like Australia. This example highlights a significant aspect of geopolitics, its ability to create winners and losers. This can result in lasting change, which can have tangible impacts on investors. So what strategies can investors employ to navigate geopolitical risk and capitalize on opportunities? Establishing a solid risk management framework is essential for investors navigating geopolitics. Questions such as, what does the company produce, where are its products made, and who buys them are essential starting points. Take Apple, for example. 95% of its products are manufactured in China, and China also accounts for around 20% of its revenue. With ongoing US-China tensions, it's vital to understand how companies like Apple are managing these challenges. So, gathering information is crucial. This can involve reading company reports, digesting analysts and strategists' perspectives, as well as books and podcasts. Often short-term shocks can be surprising, and it can be challenging to respond if you're not prepared. Scenario planning is key for readying yourself for potential geopolitical shifts. Questions like, if this scenario unfolds, what will be my move, may help investors prepare for possible scenarios. While some risk can be managed through a framework, it's often the unforeseen black swan events that drive the most change in markets. Diversification is a classic approach to address this. In this case, it's about spreading investments across different regions and sectors to buffer against short-term crises and long-term shifts. But diversification doesn't only offer downside protection, it can also be a proactive strategy. By identifying trends, companies, and countries that might benefit from geopolitical changes, investors can position themselves advantageously. Additionally, it's important to consider your investment time frame. Adopting a long-term perspective, particularly when investing in indices for instance, has the potential to help mitigate volatility and geopolitical risk. In turbulent times, many investors also look to safe haven assets like gold and defensive stocks in relatively stable sectors such as consumer staples. These assets have historically tended to perform well during crises, providing a buffer against market volatility. Aerospace and defense stocks is another sector that some investors turn to during geopolitical crises. For obvious and sometimes unfortunate reasons, these companies can see their stock prices rise significantly during conflicts, outperforming broader indices. Lastly, the digital landscape may offer a strategic advantage. Companies like Alphabet, Meta, and Adobe, which focus on digital services, may face fewer physical supply chain risks and are less constrained by geography and nation states. At the end of the day, one thing remains certain, and that is that geopolitics has had a profound impact on financial markets, and likely will continue to do so into the future. While some future events may be anticipated or even priced in, others will undoubtedly arise that defy our current imagination. While investors cannot see the future, they can control their investment framework and decisions. As Peter Drucker once said, the best way to predict the future is to prepare for it.